Welcome back to Investing Talk Podcast.
Today we're looking at applied digital.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. Applied digital, they've really become one of the most talked about infrastructure stories recently.
They really have.
And it's all because of this just dramatic, high-stakes strategic shift they executed over the past year.
And when you say strategic shift, I mean, this is fundamental, isn't it? They essentially traded one industry for another.
Oh, completely. They went from primarily building crypto hosting infrastructure.
Which was always a pretty volatile, margin-pressured business to be in.
Exactly. And now they're all in on becoming a dedicated leader in, well, hyperscale AI data centers.
It's the definition of a pivot that completely re-rates the company. I mean, they're not just building generic server farms.
Not at all. They're focused squarely on high-density compute, which is just tailor-made for those really demanding AI workloads. This is where the big long-term contracts are being signed.
And those long-term contracts would immediately just jump off the page.
Yeah.
This transition wasn't speculative, it was anchored.
Anchored by commitment.
Nearly all of the new capacity they're building is not just planned, it's pre-leased. We're talking about massive contracts that span, what, decades?
Multi-decade terms. The level of contractual visibility here is almost unheard of for a company that's still in such an aggressive growth phase.
So give us a sense of scale. How big are we talking?
To give you an idea, they've secured over $16 billion in committed leases.
Wait, $16 billion with a B. For a company whose annual revenue just wrapped up at about $144 million.
That's the number. It's staggering.
How do they pull that off?
They captured the interest of true industry heavyweights. That $16 billion backlog covers around 600 megawatts of capacity, and it's anchored by these huge agreements with clients like CoreWeave.
So they basically got their foot in the door at the exact right moment.
Precisely. The moment the market realized there just wasn't enough AI compute infrastructure to go around, they acted as a rapid deployment solution for major players who are desperate for space.
So they've traded that short-term sort of transactional crypto business for the highly predictable recurring revenue of hyperscale AI. The security has to be translating into massive revenue acceleration, right? That's the inflection point.
Absolutely. If you look at their fiscal year 2025 revenue, it's set at $144.19 million, which, was fine.
Fine, but not exciting. Where are the numbers now? Where's the growth spiking?
Okay, so in the first quarter of fiscal 2026, their quarterly revenues soared to $64.2 million.
64.2.
That is an 84% jump year over year, and that spike is almost entirely from the new AI infrastructure capacity coming online.
That's a huge sign that the operational leverage is finally starting to work. And looking forward, they're not expecting this to slow down.
Not at all. Forecasts are suggesting revenue could more than double in 2026, hitting well over $300 million.
This puts them right at the center of the AI compute surge, which is just a powerful secular tailwind.
A huge tailwind. I mean, the AI compute market itself is expected to grow at a compound annual growth rate of, 25.6% through 2034. They are surfing a wave that is only getting bigger.
Okay, so that's the immensely attractive bull case. High growth market, massive pre-sold contracts, and very clear revenue acceleration.
Yeah.
But let's be realistic. That kind of expansion costs a fortune up front. What's the trade-off?
And that's where the high-stakes gamble comes in. This is crucial for you to understand. Despite that robust top-line growth and the backlog, the company is still reporting substantial net losses right now.
How substantial are we talking?
For fiscal year 2025, the net loss was a staggering $233.68 million.
Wow.
And that loss didn't shrink. It actually ballooned by 56.5% compared to the year before. That just shows you the sheer upfront cost they're absorbing.
It sounds painful, but we know why they're taking that hit.
Yeah.
It's all the heavy upfront investment, right?
Right. Data center construction, the fit-out costs, getting all that power infrastructure ready for those key long-term tenants like CoreWeave.
They're spending the money now to secure cash flow for a decade down the line.
Exactly. And the future outlook strongly suggests these are temporary growing pains. Earnings per share are forecast to improve dramatically.
From where to where?
From a loss of $1.16 in 2025 to a much smaller forecast loss of just 39 cents in 2026. The market expects that profitability inflection point to hit pretty quickly as more capacity comes online.
But to fund this is where the risk level truly spikes for me. they had to execute an incredibly aggressive change to their capital structure.
You're talking about the debt offering back in November 2025.
Yeah.
The company priced a huge $2.35 billion in senior secured notes due in 2030.
Let's just pause on that number, $2.35 billion raised in debt. For a company that had, as you said, $144 million in revenue last year, this is an all-in move.
It's betting the farm on flawless execution.
But that size of debt issuance, it also signals that the capital markets believe in this pivot. I mean, it's a huge stamp of approval.
It is, especially considering they managed to get a B+ credit rating with a positive outlook from S&P Global. That indicates improving credit access even with all the leveraging.
Okay, but that level of debt brings us straight to the risks, and we have to detail them.
Absolutely. First, there is massive execution risk.
Hmm.
If there are construction delays, major cost overruns at sites like the Ellendale campus.
That Polaris Forge 1 site.
Or if the client ramp-up is even a little bit slower than expected, every single one of their margin calculations gets pressured.
And we can't forget the customer concentration risk. I mean, having CoreWeave anchor the capacity is a huge win for visibility. But it also means a very large chunk of their contracted revenue relies on just a few major clients. If any one of those partners hits a snag, the impact on Applied Digital would be significant and immediate.
It's the classic double-edged sword. High visibility, high concentration.
So how do they mitigate that? They must have some kind of competitive edge.
They do, and it comes down to operational advantages, specifically around location and energy efficiency.
This is where the story gets really interesting. They deliberately avoided the typical coastal data center hubs. They chose to build deep in the Dakotas. What's the genius there?
It's all about power, cost, and accessibility. They have unparalleled access to low-cost and critically renewable power.
And when you're running high-density AI servers 24/7, power is your #1 operational cost.
It's everything. Having that structural advantage over competitors building near dense, high-cost coastal markets is a massive long-term moat.
And it's not just the low cost. It's the efficiency of the facility itself, which plays right into the ESG mathies of their clients.
Exactly. They're touting state-of-the-art energy efficiency. Specifically, they're aiming for a projected power usage effectiveness, or PUE, of just 1.18.
Okay, let's unpack PUE for a second. What does 1.18 actually mean in practice?
PUE is a measure of how efficiently a data center uses energy. A perfect score is 1.0, meaning every single watt goes directly to the computers.
And most data centers are nowhere near that.
Right. Most modern enterprise centers run closer to 1.4, maybe 1.5. Hitting a consistent 1.18 is practically best in class. That translates directly into huge cost savings for the tenants over the life of the lease.
Plus, they're focused on near-zero water consumption, which is another huge ESG concern. So they aren't just selling space. They're selling highly efficient, low-carbon, low-cost compute capacity.
Which is exactly what large companies need for their ESG reporting. It's a powerful combination, a structural moat that's very hard to replicate quickly.
So with all this dramatic news, the pivot, the backlog, the debt, how is the market reacting? The stock itself is showing extreme volatility.
Exceptionally volatile. It's reflected by a massive 7.06 beta.
7 beta, let's explain that. That number is basically rocket fuel.
It is. If the broader market, say the Nasdaq, moves 1% on any given day, this stock is mathematically expected to move over 7%. That signals immense momentum, but also extreme risk.
The momentum, though, is definitively strong. Technically, the stock's been trading above both its 50-day and 200-day moving averages, which confirms this uptrend is real.
And we've seen the wild swings. The 52-week trading range is immense, going from just $3.31 all the way up to $40.20.
It's currently sitting in the low to mid-20s, but the analysts are incredibly bullish. The consensus is a strong buy from multiple firms.
And the targets back that up. We're seeing 12-month average price targets near $30, suggesting pretty strong upside from here.
And that's just the average.
Right. The most optimistic published targets are pushing up near $43. It's a clear signal that the market believes the company is undervalued relative to its contracted revenue pipeline.
So heading into early 2026, a plausible trading range might be somewhere between, say, $24 and $32.
That seems like a reasonable expectation.
Okay, so if we accept the momentum and the analyst view, what are the immediate catalysts? What should we be watching for over the next 3 months?
The most critical near-term event is the upcoming earnings release, either Q2 or Q3 of fiscal 2026, which should be January or February 2026.
And what is the street looking for?
They'll be looking for that robust year-over-year revenue expansion, which is expected, but the real driver will be continued improvement on the bottom line. Investors need proof that the operational leverage is truly starting to kick in.
Any upside surprise there, especially showing a quicker path to reducing that net loss, could trigger a rapid re-rating.
It could. And operationally, we're also tracking management's stated pipeline. We're looking for announcements on additional AI data center lease wins.
Another big client or maybe an international expansion.
Exactly. Any successful execution on that pipeline acts as a catalyst.
And then, of course, you have the speculative themes. The rumors.
Which are adding a lot of fuel to this story. We're hearing chatter about potential new massive hyperscale lease wins in Europe or the US beyond what's already public.
And there's also the fascinating speculation about them moving into sovereign AI contracts.
Which means building specialized, secure data centers for national governments. Winning a contract like that wouldn't just be about revenue. It would be a major validation of their security and capabilities.
And finally, the perennial rumor in this space, M&A interest.
Always. Given the strategic value of these campuses, there's always speculation that an industry giant might look to acquire them outright to instantly gain this pre-built, pre-sold infrastructure.
Now, those are pure speculation, but if any of them materialize,
You're talking about an immediate and aggressive upward spike. It speaks volumes about the perceived value of what they've built.
so what we have here is a company that has pulled off a successful but incredibly expensive pivot. They've leveraged their balance sheet to the hilt to become a first mover in foundational AI infrastructure.
That's the story. This investment is defined by that dual nature. It's high risk because of the capital intensity, the debt, the execution complexity. But the immense reward potential, I mean, if they succeed, they will be foundational to the future of AI compute. It's a true high-stakes, high-reward bet on the AI boom.
If you want to stay on top of developments like this and keep getting the analysis you need, make sure you hit that subscribe button.